Okay, let's get started, guys. Okay, so hi everyone, Richard Jackson here. Thanks for joining me to learn more about some new opportunities that I have in Jackson Capital. Now, all of you know that I have been working with a team of quant analysts in Europe and the United States with the view of providing a better service for everyone. And an opportunity has now emerged with this team, which I want to present to you today. So first, our broader quant team has developed a unique FX trading strategy. And second, we have a business model and a team that will deliver a portfolio and investment products built around this more evolved trading approach. So today what I want to introduce you to is our partners, our research and product development approach, the investment management approach, our trading strategies, JC05 multi-strategy and JC07 contrarian sentiment strategy. Okay, so for those who don't know us in the room, Jackson Capital is a foreign exchange investment management company based in Melbourne, Australia, and we specialise in quantitative research-driven approach to trading FX. So the big takeaway here is that our company brings together a wide pool of people and skill sets, all of who really will be focused on the performance and management of your account. So let's talk about our investment committee and how it will deliver portfolio management. We have a formal investment committee to widen the number of people and skill sets thinking about the performance of your account. These include economic and quant analysts from US and UK. Jackson Capital is the investment manager and all investments will be managed by our investment committee. Also, Jackson Capital will deliver experienced traders and intellectual property, and through a managed discretionary account agreement through Alpha Broking, who's one of our partners, and Pepperstone will deliver execution and custodial services for your funds through a Pepperstone account. Okay, so Jackson Capital aims to achieve a net return in excess of 20% per annum on invested capital using our proprietary managed currency strategies. They're all designed to perform well through market volatility. And of course, there can be no assurances that the MDA will achieve its investment objective. However, you will be able to see the historical results for yourself and make an informed decision for yourself. Okay, so what are we offering? Jackson Capital provides trading strategies with varying risk profiles that really provide the opportunity to diversify and manage risk through your trading portfolio. So under the guidelines of responsible investing, I encourage participation in both JC05 and JC07 trading models, which will give you broader diversification. Obviously, again, this type of product should be part of your portfolio, not as and your entire portfolio. Because it is a derivative, you can have a small amount of money allocated to this. So really no more than 10% of your investment portfolio should really be allocated toward derivatives anyway. Now let's talk briefly about JC05, as I don't want to focus on this too much today. This is our multi-strategy and is an algorithmic trading system on FX and commodities. This system identifies price patterns for emerging and breakout opportunities. And this strategy employs a number of proven strategies within it to smooth out the return of the equity curve, and typically trades within a day or two across majors and crosses. We don't really go into exotics on it. So you can see there its performance over the last year and 3 quarters, and what its net return is per year on that. Okay, so let's have a look at JC07. This one's the big one. This is what I've brought you all into the room to see, and I'm going to explain to you how it works. JC07 is a sentiment-based algorithmic currency trading system. So its primary function is collecting and aggregating retail data from some of the leading or world's leading FX firms. And it leverages this non-public information to make trading decisions. So let's dig a little bit deeper and see how it works. Now the focus here is on bad retail traders. And what we want to do is we want to do the opposite to what they are doing. So let me explain to you how the OTC broking industry works. Market makers know a very important statistic, and you may know this statistic too, that 90% of all retail traders lose their dough, lose their account. And these are typically small accounts, so less than $20,000. With these accounts, market makers run these orders off market on what's known as a B book. And off market simply means that it's not STP, DMA or ECN. Now STP means straight through processor, DMA means direct market access, and ECN is electronic communication network. So in other words, the orders are not sent to the market, but instead traded in a virtual market using the prices of the actual market. So A book, there's two books. There's an A book, which is good traders, where orders are sent to the market. And B book is bad traders, which orders sit off market. So when a retail trader account is run off market on a B book, this means any losses incurred by the trader is 100% owned by the broker and not the other side of the market. And this poses a risk for the market maker in that if the client wins, the broker can lose. So knowing this, the market maker can hedge the positions on the market. And yes, you guessed it, this is where a conflict of interest can come in. People argue that market efficiency is tampered with when this happens. However, today, I'm not here to be a Guy Fawkes for market efficiency. The fact is, this happens, and market maker brokers take the opposite side of bad retail traders. So if 90% of retail traders lose their money, brokers, hedge funds, banks will make the money because it's a zero-sum game. Okay, so if somebody loses, somebody has to win. Okay, so the question is, why do retail traders lose? Well, it's pretty simple. It's human psychology. Bad retail traders make two crucial mistakes. They hold their losers too long and they cut their winners too short. And here in this slide, you can see the average profit of some of the large retail OTC brokers. This is based on funds under management on their B book per quarter for the years 2013 to 2014. You know, see between 20 and 30% on a regular basis. 20 to 40%, sorry. So do these traders trade against every single $500 account? Well, no. Typically they're far too busy and far too big for that. So what they do is they trade against the net position of all of the losing retail traders at any given period of time. So basically, they trade against the aggregate data of all the bad traders. And for us, Jackson Capital, to trade this information, we need to know what the net position of all these bad retail traders are combined, which we can do through a sentiment index. And this is we've built one here of 16 of the largest brokers, B-book data, and we can then analyze this sentiment. And when we find a large divergence in the sentiment, we then trade against it. So we don't just use the sentiment. It's not that simple. To make it more of a quantitative approach, we have additional filters to improve the success of the system. Okay, so some of these are that we only get in to trades based on B-book data when the sentiment is significantly diverged. We use volatility and momentum filters to get in at the right time. We use risk controls, i.e. stop losses, trailing stops, etc. And we only trade on pairs which meet the minimum volatility requirement. Okay. Okay, so let's have a look at the results again. Here's a heat map of the last 5 years or 5.5 years. And of course we're trading, so there are losing months, so we've got to be prepared for that. And if you're going to participate in this strategy, you'll need to have an investment horizon of about 12 months. However, you can withdraw at any time as there are no redemption periods. A few things to note in this slide. History over 2,000 days. It's pretty big. Pips is possible. Pips is positive, which means that there's no averaging or martingale. Profit factor is above 1, which means it's making money. Peak drawdown is 27%, this is the historical maximum drawdown. However, I want to point out that we have an overriding maximum drawdown of 40%, where we'll stop trading if the master account reaches this. So your max risk is 40%, but when it approaches 27%, we will be looking at it closely. But we've got to put in there a hard stop of some sort. And I wanted to put it far enough away from the peak drawdown, historical peak drawdown, so that we would have room or a buffer. Okay, so here's a cumulative percent return per month chart, so you can see, what its performance has been like. Earlier on this year had some nice performance. Here's the same one as a bar chart. Now, what I want to point out here is this is the reason why we have the 12-month horizon on it. You can see, let's pretend that you got in here on the first of the first 14, and we know that the beginning of 2014, trading or volume on the FX market was very low. So you can see here, because of lack of volatility, it didn't really do much. So if we count here, 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. 8 months. We sat through this period for 8 months and we didn't really make any money. But come into the 9th month, which was September, it basically made up for the entire year. So we've got to have a long-term horizon on this particular strategy, and then you'll see some benefits out of it. But if you're looking at it from month to month and you want a positive return every single month, then this is probably not for you. Okay, next. Here is trade profit, percent profit versus trade duration. Most of it's within the 500 hours. So the average time that a trade is held is around 4.5 days. Okay, so just to quickly have a look at the fees and costs, there's no monthly subscription fee, there's no entry or exit fees, and there's no redemption periods where you can access your funds at any time. So let's have a quick summary of this particular trading strategy. 90% of traders lose. Fact. We aggregate the retail broker B-book sentiment data. We trade the same side as market makers. We have a huge history of over 5 years, which is averaging above 30% per annum gross of commission. So you need to have a 12-month investment horizon because it's a longer-term strategy. Expect drawdown. Your max risk is 40%. Historical drawdown is 27%. And I'd encourage everyone to read page 8 and 9 of our product guide, which talks more about risk and return. Diversify across both JC05 and JC07, which will spread your risk. And minimum account size is $10,000, and we make our money through a 2 pip markup, okay, which is quite small. All right, now get your questions ready, guys. I'm sure you've all got a lot of questions, and this has been fairly quick. I didn't want to waste too much of your time. So we can go back through the slides if you do have some questions. But here's some information. Give Michael McAllister a call. He's our account manager. You can catch him there on his email address and phone numbers. We're going to send you a video of this webinar. I've also given you the product guide already, but I'll send it to you again, account opening instructions, etc. What I also encourage you to do is jump onto our Facebook page, because I release economic news and strategy, etc., from upcoming news events, all those sorts of things, both on our Twitter and Facebook page. And if you want to look at our recommendations, please go to my LinkedIn page just there. Okay, so questions. Let's have a look at your questions. Okay, guys, I'll leave it there. If you've got any questions, please call Michael or myself. You can get me on the same number there, and hopefully we will speak soon. Okay, thanks, guys.